Good afternoon, and thank you for joining our call. The plan is for our team to talk for about 25 minutes on our performance, the positioning of the portfolio, and the outlook. Within the outlook section, we would like to update you with our perspective on inflation and our thesis on a new driver of global growth, which has emerged partly as a function of the pandemic. Thank you for the excellent questions already submitted, and do send more if you wish. Could I please ask you to note the disclaimer? The presentation will be led by Jerome, our CIO Chris, and Katerina, the Deputy PM of the WorldStars and Head of ESG. I will now hand over to Jerome.
Thank you, Sandy. Good afternoon to everyone who has joined us, and thank you for taking the time. We're pleased with the development of our WorldStar strategy and the performance it has delivered. Our business is growing well, with AUM now over $1.2 billion, supported both by strong performance and inflows. About 25% of our assets are owned by my family and the partners, and the balance by other families, charities, trustees, wealth managers, and institutions. The WorldStar strategy is now over 9 years old and has delivered results well ahead of our target return of 8 to 10% per annum, or more over the long term. It invests in a concentrated group of 20 to 30 high quality, sustainable, global large cap and mega cap stocks with enduring competitive advantages and a long runway of growth, selected through our intensive in-house fundamental research. Quality is our defining condition, followed by value. ESG is now fully integrated into our investment philosophy, and we strongly believe in the correlation between ESG, sustainability, and investment returns. The strategy is available through separate managed accounts or through our UCITS fund. Investors can invest alongside my family in a strategy that has successfully generated strong returns over more than 60 years. I'm pleased to report on continued strong performance by our WorldStars fund, both in absolute and in relative terms. Our fund ended up 2021 up 19.7% in dollars, in line with the MSCI World Index in a year of cyclical recovery and rotation. It was the third consecutive year with a total return of around 20% or more. Including also the recent sharp rotation in January, on a 5-year view, the WorldStars has delivered 15.5% CAGR in US dollars, 16% or about 2% per annum ahead of the MSCI World Index. We see the current volatility as an opportunity, as valuations of our companies have compressed significantly. And yet, most of them continue to report very robust trading. Only in the last few days, a series of luxury goods and consumer goods companies have reported on continued strong demand in China, which bodes well for our position in LVMH, for instance. Last week, Activision Blizzard, a stock which we have owned for 5 years, received a cash offer from Microsoft at a 45% premium. Activision's share price was depressed by the recent issues it has faced. The fact that Microsoft paid such a premium confirms Activision's quality and long-term growth prospects. Yesterday's significant market action also showed that there are buyers that will step in as prices decline. That is why we remain optimistic about global recovery over the next 2 to 3 years. And we are also confident in the ability of our focused portfolio to continue to deliver significant value over time. I'll now hand over to Chris.
Thank you, Jerome, and welcome to everybody who's joined us. Like in previous updates, I wanted to spend a short moment just reminding us all about our definition of quality and value before going into the update and some of the issues that we want to discuss with you. So for us, quality is a gating condition. There are 4 key criteria that we look for the quality of the companies we invest in. Those are a strong and sustainable competitive position, always also in the sense of ESG, and with a conviction that only companies that are sustainable can have sustainable competitive advantage and deliver sustainable returns. The second is a good and growing industry, so some reason why there is a growth, whether that is from populations, economics, demographics, preferences, or research and innovation. A management with a record of value creation, so being active investors, representing our interests where we need to, but not looking to be activists. And finally, a balance sheet so strong as to weather any kind of adversity, meaning that the companies have the flexibility to operate in challenging environments like we've seen with the pandemic that's just happened. We think that criteria is one of the key reasons why they've been able to do as well as they've done. And so this perspective, it's a gating condition and a kind of checklist, and a company can be as cheap as it wants. If it does not fulfill the quality criteria we're looking for, we won't invest. So this perspective takes us into a view where we think we are in a world where it's about OPEX, not CAPEX, where it's about intellectual capital, not physical capital, and where it's about the cash flows that companies generate and the way that they allocate their capital, and not so much about some kind of return on tangible or intangible capital that has been invested or crystallized through some kind of transaction. It means that we are also invested in companies that are not as capital intensive. It means, as we've discussed and as Katarina will take us through, that the portfolio is extremely robust from an ESG perspective in terms of having a low carbon footprint and other types of criteria. And it also means that we think that it's very well positioned for inflation, which is one of the key concerns that we have, and we think one of the key macroeconomic drivers for what's going on in markets right now. To us, value is buying those companies at prices that allow us to generate returns of 8 to 10% or more, in some cases much more, as we have over the long term. And quality is an enduring condition, whereas pricing is an opportunity. And we're clearly in a moment right now, as we have been at various times since 2012, where we are having an opportunity because market prices are moving and stocks are getting mispriced. If we shift to the portfolio composition, then it's been highly consistent. It continues to be invested entirely in the US and in Europe, the most liquid markets with the most robust track record, corporate governance and alignment between investors, companies, and their boards and other stakeholders. It continues to be entirely exposed to the global economy in terms of where the companies actually do business. It continues to be highly diversified within the industries that we look to invest in. As you can see from a standard sector allocation perspective, we like the areas that we invest in. We avoid capital intensive businesses. We continue to avoid balance sheet driven financials. We avoid resource intensive businesses, and we avoid regulated businesses where governments can play a significant and disruptive role for the companies. And finally, from the underlying exposure, you can see that it is, however, also highly diversified in terms of the underlying drivers for the businesses that we look for. So about a third of it is in digital transformation, broadly defined, 28% in consumer, 23% in healthcare life sciences, but importantly, 18% in industrials and infrastructure. And so as we'll see in a moment, when we look at the returns that we've generated last year, from the companies that have contributed to it, we're not just reliant on digital transformation or individual stocks within that as a driver. We're not just certainly reliant on some kind of high growth of the businesses that we invest in. We're not just reliant on quality and brands and compounding returns from consumer products and healthcare and life sciences companies. And we have exposure to companies that have industrial demand and that are therefore more cyclical in terms of the profile of their businesses, and are well positioned to benefit from the strong economic recovery that has already been taking place post the pandemic, and that we expect to be sustained and, if anything, to accelerate over the next several years, as we'll go through. So if we shift to the perspective that we have here of how these stocks have performed last year, you can see that it's a very different picture than the one that we showed at the end of 2020. We've been in an unprecedented global pandemic. It is the shortest and sharpest shock that is imaginable. We are now seeing the sharp recovery thanks to the vaccines and therapeutics that we have that are allowing us to address the issues. And we think it does look that like we are coming out of the acute phase of the pandemic, and it will become endemic as Omicron and potential variants will hopefully be less virulent in terms of the impact that they have. In 2020, it was entirely about the stocks that benefited in one way or another. So whether it was the digital stocks around e-commerce, around entertainment like Activision, or other types of companies that have benefited from the stay-at-home phenomenon and from the general shift from offline to online that took place as the pandemic, that's what drove the returns last year. It was Amazon was our single best performer, up over 70% for the year. Those are the light blue bars in this graph. Now this year you can see the best performer is still light blue, that's Alphabet. That's a question of digital advertising, which is somewhat more cyclical. It performed very well in 2020, but it was up also over 70% this year in 2021. And so therefore, the largest contributor that we had. I think it's very important to note that despite that strong performance, it's still one of the cheapest stocks that we have because the sales and the earnings and the cash flows have very much kept pace with their share price development. And so therefore, the stock has actually derated in terms of the valuation that it has. But I think the other important thing, if you look at this, is that you can see that the performance has been highly diversified. Some of the best performers are the industrials and infrastructure type stocks that we own, some of which we only bought last year because they became so much cheaper as part of the dislocation that we had in 2020, some of which are stocks in the consumer space that have benefited from the recovery that we've seen in consumer demand, whether that's in luxury and spirits or in other things. Some of them have been in healthcare and life sciences, where this offset between the returns that the business that they've been able to generate from testing versus the disruption from the closure of hospitals and the postponement of elective surgeries was resolved in a positive way. So you can see it's a broadly diversified set of drivers that have contributed last year. And it's this diversification and strength of the portfolio that also makes us comfortable that we will be able to continue to perform in an environment like we're facing now, where there will continue to be different drivers for the companies and their performance. I think it's one thing to highlight is the bar on the lower left. The worst performer last year was Activision Blizzard. Jerome already alluded to it. It's one of the world's leading gaming companies. It just got a cash bid from Microsoft at a 45% premium. We are not surprised. We have very much the conviction that if companies have underlying quality and the market is not willing to pay for that, then other people will. Microsoft has over $130 billion of cash on its balance sheet. Activision is a $70 billion acquisition. So it is entirely funded from available cash. Also saying something about the capital allocation and resources that are available. Activision had very significant issues, in particular around sexual harassment that have disrupted the business that they have had to address. We've engaged actively with them and have been concerned about it, but we have also come to the conclusion that we thought that the underlying business was strong and that therefore at the valuation it was trading, it was an attractive investment, and that certainly has been vindicated by the offer that Microsoft has just made. So if we then look at what the outlook is and what has been driving both the performance over the last 2 years, but in particular also is going to influence the outlook. You can see here we've looked at the revenue growth that our companies have been able to achieve. And you can see it's a bit all over the place. The digital companies have very substantial revenue growth going forward, and digital for us includes companies like American Tower and others that are infrastructure providers to digital transformation, and that by definition have much lower growth than some of the digital platforms. But I think the really important thing to see is that they've delivered sensible growth. The ones that have been impacted by the pandemic have had a significant setback in 2021. That they've reversed in 2020. They've reversed that in 2021 because in part the comparison was so much easier. And what we're facing now in 2022, I think, is the ongoing transition that you have at a time of volatility like this, where the comparisons matter. The market likes situations where there is steady and a strong growth and where companies can beat and raise. It does not like periods where there are slowdowns and where there is uncertainty because of this difficulty of comparison. It's something that has happened since the third and fourth quarter last year. It explains, I think, some of the movements that we've had, and I think it's something that will be with us through 2022. But if we understand it from a fundamental perspective, it's also a source of opportunity. Because it means that as we go through, the comparisons will ease and we will get back to understanding that the recovery that we think is ahead and that we're seeing in the actual underlying reports of the companies we're invested in will allow them to do well going forward. So if we then look at a chart that we've showed you before to talk about the positioning of where the portfolio is from a valuation perspective compared to the growth that the companies generate, you can see that we think that quality is an area that we have high confidence in and that is distinct from growth and value in the more traditional asset management senses. We've identified growth as companies with high PE multiples for simplicity and value the value in terms of the price to earnings multiples that companies generate. You can see that the portfolio is positioned right in the middle in terms of that. We're expecting for 2022 earnings per share growth of roughly 10%, and the valuation now, having come back, is roughly in the mid to high 20s in terms of the near term earnings. But that's in part a function of some of the companies still being at higher multiples because of the growth that they're achieving, but some of them are still facing recovery earnings and therefore depressed numbers that we expect to improve. But I think it's a graphic representation of where the portfolio is, and that it provides a balance between these different type of factors. If we then look at what the actual performance has been and what the growth versus value rotation has done. This is the S&P 500 Growth Index versus the S&P 500 Value Index, just two available indices that are interesting for comparison reasons. You can see how the growth has continued to perform extremely strongly over the last 5 years. But if you look at it since for 2021, and this year, you can see the moves have been very substantial as that has partially reversed. The first of this happened in 2021. We talked about it as an opportunity because you had a reversal where value stocks accelerated very substantially, whereas growth stocks flatlined. It then caught up, and we think that's in part because of the strong growth that these companies have generated, and in part perhaps because of concerns around the Delta and Omicron variant that took place from the summer of last year, and that led to that gap to close. You can see that we've had movement since then, and we're now currently in a very substantial rotation again, where the scissors have opened up. There's other charts that are at least as interesting as this that one can look at, but in the same way that last year we think that this will reverse over time, we think that the same will take place now. It's certainly, we said that it's not just volatility that's an opportunity for long-term investors, but rotation as well. And it certainly was a great opportunity in the second quarter of last year, and we think the same is going to be true this year as well, as the fundamental outlook comes through. So with that, I want to conclude on the review and the comments, and I want to turn over to Katarina, who is going to talk to us about the ESG and engagement activities we've done.
Thank you, Chris, and good afternoon all. We have spoken in the past about our ESG approach. What I wanted to do today is, however, touch on a different aspect and give you a summary of our stewardship activity for the year 2021. One of the key aspects of our investment approach is that we seek to be active stewards of our clients' capital. This means engaging with our investee companies and using our voting power to drive change. If you look at our record over 2021, we engaged on over 100 occasions with our investee companies, up from 65 times the year before. This included talking to the CEOs, the CFOs, chief technology officers, and heads of sustainability of our holdings. In fact, over 60% of our engagement was with such C-suite executives. And I want to highlight that importantly, this is a two-way communication process. We are there not just to listen, but to also give feedback to the managements and offer advice on strategy, capital allocation, and increasingly over the last few years, ESG issues. We also use our vote to drive change. During 2021, we voted on the annual general meetings of 36 of our investee companies. Of note, we voted against the management recommendation in 19 occasions, pushing for better diversity and inclusion practices, stronger environmental policies, and more transparent governance structures. In fact, you can see from the chart that we voted with shareholder resolutions and against the management in 33% of the times when it comes to shareholder rights, and almost 50% of the times when such a resolution came up on environmental and social issues. Now, let me pass back to Chris, who will talk about one of our key investment themes going forward, and one that is closely tied to ESG, the transition to a net zero economy.
Yes, thank you. We want to talk about drivers. So we see three drivers for global growth and for the companies that we invest in going forward: globalization, digitalization, and capital investment. The first two have been drivers that have been with us for a number of decades. Globalization, we can quibble about the start date. We put it at the 1990s, where it's about delocalization of production, global supply chains, cost arbitrages on the one hand, but on the other hand about the development of very large new consumer economies, in particular in China and Southeast Asia, that have completely transformed the global economy. Some of that has taken place at the expense of the environment, as the resource demand in terms of energy and other resources that is required for this kind of growth has been significant. So it's accelerated some of the challenges, but it has delivered significant benefits in terms of economic growth that are going to be ongoing and with us. The second one is digitalization. We think there's a number of phases. The first one is around the ERPs, systems like SAP that have been implemented by large global companies and have allowed them for the first time to manage their business on a global basis. For a company like Nestle, Project Globe took over a decade to implement. It's only in the mid-2010s that they were able to put the last country fully online and to reap the benefits from that. And we think it's one of the reasons why corporate margins are so high in companies that operate in good industries where the structure allows them to retain the margins and not to have them competed away. The second phase is, broadly speaking, the internet. So whether that's e-commerce, whether that is social media, or whether it's on the product side, the smartphones and tablets and other devices that we've developed. Part of that is from 2000. The other part is from 2010. Again, it doesn't matter from where we really put the start date, but it's very clear that we're only partially of the way through. We could say, are we a quarter of the way through those kinds of changes? We don't know, but very clearly they've been significant sources of disruption, but also of opportunity. And there's a long way to go. You can see what an important part digital transformation is of our portfolios. And that has been joined by a third phase, which we think is blockchain. To us, to some extent, it's about asking the right questions, not necessarily having the answers, but we're certainly asking the same questions about blockchain that we used to ask about the SAP systems and about cloud computing. which is that it has the opportunity to completely transform the way that software works, that computing, data storage, and data processing works, and to lead to further security improvements, which is of significant importance, but also efficiency and innovation in terms of how transactions and other parts of the IT requirements go. And so we think these are questions that we need to ask, and that will be ongoing opportunities that we need to understand. But the important thing and what we want to convey is we think we also have a third phase a third driver for global growth that is taking place, and that is capital investment. The global capital base, and in particular the American one, is as old as it's ever been. That's both public and private capital base. It's requiring significant investments, and Katarina will take us through some of the numbers to upgrade and improve it. It is both to have capacity for growth, which we have not invested in for a long time, but also greater efficiency. There are tremendous opportunities to implement the technologies that we've developed over the last decades at scale to achieve a foundation for global growth, but also to address some of the significant challenges that we've had as a result of the globalization and to a lesser extent of the digitalization that we've had, and in particular around potentially the biggest issue of all, which is climate change and global warming. So Katarina will talk to us about the issues we see there, but also the opportunities for the companies we're invested in.
Thank you, Chris. Some of you will have seen our December Insight. If not, I would encourage you to read it, which focused on the transition to a net zero economy. This transition will require effectively the complete bottom-up transformation of the global economy. It will need to take place across all industries, including the power, industrial, construction, transportation, and agriculture sectors, translating, we believe, in a once-in-a-generation super cycle of investments in the capital stock for the decades ahead. In fact, to meet the stated climate goals, an estimated $3 to $5 trillion annually, I repeat that, $3 to $5 trillion annually, will have to be invested in the decades till 2050. This means 100 to 150 trillion of cumulative investments, translating into significant opportunities for us as investors. Now, as we look at this transition to net zero, it is important to note that our portfolio is exceptionally well positioned. If you look at the carbon intensity of the WorldStar strategy, it is over 70% less than that of the market. This reflects the fact that, as Chris said, our investment focuses on IP-rich, knowledge-based companies and less on the owners of heavy industrial assets. It also reflects the best-in-class environmental practices that our companies implement. Equally importantly, our companies have a key role to play in this transition to a net zero economy. You can see here a subsection of 5 relevant UN Sustainable Development Goals that our companies in the WorldStar's portfolio align themselves with. Over a third of our holdings believe they have a role to play in tackling climate change, fostering responsible consumption, building smart and green infrastructure, or creating sustainable cities, and have placed these goals at the core of the strategy. These names are cross sectors, whether that is in industrials, technology, life sciences, or the consumer space. And this translates into significant revenue opportunities for them. Now, I'll take one example here, Eaton. Eaton is a leading industrial company that provides solutions that manage electrical power. As we noted earlier, the power, transport, and building sectors will require significant investments to enable that transition to net zero. This includes investments in renewable resources, storage, smart grid infrastructure, but will also mean the acceleration of the growth of the electric vehicle market and the ultimate electrification of the aviation sector. Eaton plays in all these themes. Now, if you look at the stock, it has been a great holding for us, delivering 18% annually since 2014. But we believe we're just on the early innings of the opportunity, and there's much more to come as the company benefits from these accelerating structural trends. Now, if we look at one area more closely, the power sector, it represents 30% of global emissions and will require an approximate $60 trillion by 2050 to decarbonize. This will mean that we will have to redesign how energy is generated and how it is consumed. Now, what you're seeing here is effectively the grid of the future, where power is flowing not one way, but two ways. Energy will be produced and stored locally, sold back to the grid, and demand and supply will need to be balanced in a much more dynamic way. This is what we call everything as a grid. Imagine your home as a grid, your office as a grid, effectively a transformation of the way power is consumed in the economy. And Eaton is in the sweet spot of all these trends. You can see it has presence in areas like EV charging, microgrids, storage, renewables. EV charging alone is expected to be a $1 billion opportunity for the company by 2030, with Eaton targeting 20,000 related projects in Europe and the US. So a fascinating theme for us, a great investment opportunities, and we believe we are very well placed through our holdings to participate in it. And with that, I'll pass it on to Chris.
Thank you, Katarina. I think that takes us then logically to an important part of the outlook and the environment that we're in, which is inflation. Because one of the things about these drivers, globalization and digitalization, is that they've been largely deflationary, whereas capital investment that we need is clearly part of a more cyclical phase that is going to be inflationary. I think this is something that we would have seen had the pandemic not taken place, because we were getting at a point where we did not have the capacity on a global basis, and the capital base was so old that we would have not sustained the development that we were of economic growth, and it would have required the kind of investment we're now seeing. The pandemic set that back, and the bottlenecks that we're seeing are only partially a result of the pandemic, partially there, and much more fundamentally the result of this need for capital investment. But that is something that we are not worried about. On the contrary, we see it again as a type of opportunity. We're at the beginning of this driver. We're at the beginning of this cycle. So we expect the supply bottlenecks that this year in this transition phase are taking place to abate. There will clearly be a supply response in resources. There will clearly be a supply response and debottlenecking in the supply chain and in the production of other goods and services as we continue to get out of the pandemic. And there will also be as a result, there will be a resolution and abatement of these issues, even if there will be short-term spikes. The thing that comes with that very clearly is a change of macroeconomic paradigm, and so a shift away from the accommodative policies that central banks have had to employ in order to get us through, and in particular in order to absorb the shock of the pandemic. That means that there will be a tightening of monetary policy. There will be tapering, and there will also be rising rates in response to the inflation that we are seeing. But that is all part of a normal economic cycle, and so for us, it is not something to worry about. It is something, however, to be positioned for. And the kinds of companies that can do well in that kind of environment are companies that can have the resources and ability to grow, because of the innovation and the markets that they're operating in, that have the pricing power to be able to offset the inflation by raising their own prices. And companies like Nestle, for example, in consumer products, are much more able to raise their prices in an overall inflationary environment, and that have the scale to be able to absorb the increases in their own inputs. Those are key aspects of the definition of quality that we use for our portfolio, and so we think that that is well positioned. We've now looked at and we've put together an analysis that we've shared with you about the portfolio and how it stacks up on that basis. We've looked at the individual companies in terms of their market position and their competitive insulation, as well as in terms of their exposure to these risks, and we're very comfortable. Where there are areas of concern, we've identified them and we are seeking to understand them. But in all cases, they have this competitive position, they have the innovation, they have the pricing power, and they have the scale to be able to operate through this environment. And so we expect the outlook from a fundamental perspective to be very positive. And so even in an environment like we have right now, where there is this kind of rotation, where there's concerns around increasing discount rates or so, we think that over time, these companies will prevail. And so from an overall outlook perspective, we're continue to be constructive about the global economy, the recovery we're seeing, about the companies we're investing in, and their prospects to generate value through their share prices. It's a year of transition. We clearly have very significant geopolitical tensions that we're going to have to go through, and we will have to take into account. There is the possibility, as the paradigm shifts for central bank errors, although it's a year of elections in the US, in France, and other places. So we expect central banks to be extremely cautious and data-driven in terms of what they do. There's the issue of regulation that we can talk about in the Q&A to go through some of them, but we expect these pressures to subside. And as we are going into this environment, we think that the underlying performance of the companies, the growth in their sales, their earnings, and their cash flows that they will experience, the opportunities that they can take advantage of, will be sufficient to offset these challenges and mean that we should have a significant performance potential ahead. And whether this year will be one in which there will be moments of volatility like we're going through right now, again, we think that that volatility is an opportunity. The rotation that we've seen is an opportunity as well. We took advantage of it in 2020 and 2021 in terms of changes we made to the portfolio, and we expect to take advantage of it this year as well.